welcome back to Burn Rate and Beyond. Here we are with episode 8. My name is Chad Folsom, and I'm here with Mr. Jeffrey Mazza.
Hello, how are you guys?
All right, doing good. It is a wonderful Thursday. Feels like it's Monday sometimes, but here we are. Powering through. I guess what are we doing today? We are talking about debt management, right?
Debt management.
Yeah. I guess it's a popular topic because the banking industry is huge and there's lots of information about how to get loans and it's super easy. But I guess basically it's also a topic of like how to finance a business, right? So
Yep.
what is so let's just kind of dive in there, right?
Let's do it.
What's the point of borrowing money if you have a business? Is that good? Is it bad? I don't know. Let's get going. I guess this first topic, like you start a business, and is it good to borrow money right out of the gate? Or maybe that's the best question. Is that the only option to borrow money right out of the gate when you start a company?
Well, I mean, it's such a great question. You think of all the businesses that have started. I mean, you have to have some capital to kind of get going on that. And a lot of times it might be that bootstrap that some of these owners put their own money in to get going, and then they realize, okay, we're going to need some more money. And usually when a growth company will suck cash, and it's just a matter of trying to figure out how much you need, how long that will last. But from a debt perspective, it's interesting because especially early on, where a lot of owners are like, well, I don't want to give up, equity and control of the business, and debt is cheaper than the equity, and that's always that kind of, I think, the first dab into just exploring some sort of funding to provide growth capital so the business can grow. But I think that's usually the preferred option in the beginning. I think of not giving up control, getting some money right off the gate to help the business grow.
So you just said debt is cheaper than equity. And what the heck does that mean? Because I always think that debt is expensive because you have to pay interest on it. I mean, I guess when I think of debt, I think of like the easiest type of debt, which is credit card debt, which
Mhm.
you have to pay interest on immediately, and the and so it can become very expensive, very easy to get into and become very expensive. So I guess I'd like maybe you can unpack that a little bit more when you say debt is cheaper than equity.
Yeah, and usually when you think of when you obtain debt for finance, and there's the repaying that principal and then the interest, right? And depending on what the interest is, but when you look at an equity investor and you raise money from equity, again, they're not, and as an investor, they're trying to make money. Usually it's, investors want a higher return, right? 10x their money, because they're taking on more risk, and there's kind of that longer waiting period. So eventually, if you kind of do some sort of high level math, that the equity portion of your raising capital usually turns out to be a lot more than actual debt.
I see. So yeah, basically it's like under the assumption that the business grows in value and you sell at a higher multiple, some sort of multiple, even if it's lower, it can have same effect that long term you give up a lot more uh, paying other investors rather than just paying the bank, if you will, a little bit of interest over time. Interesting.
Because
So
even
then you
just
talked about, go for it.
really quick too, Chad, it's such a good topic too, but because like, I mean, even if from like a high level, like if you're, let's say, borrowing $100,000 and it's 10% interest, it's like, okay, it might cost right, that $10,000, but if you're raising that 100K in equity and give up, say, 10, 15, 20% of that business, and then, it could cost you money down the road. Maybe you sell the business and, there's millions there that you gave up that control to. Just a high level, if that makes some sense to some of the listeners.
Right. And so you're saying that like, yeah, if someone were to invest 100 grand and wanted to make 5x, they're hoping to make 500 grand,
Yeah.
right?
Yeah.
And that's, so in that sense, that's significantly more expensive even if you had to pay $10,000 in interest expense on that debt
Hmm.
for 5 years,
Exactly.
10 years, right? Um, Interesting. That makes a lot of sense. So it's that long-term thinking that makes sense to keep, to take into account. So good stuff. The other thing is, I guess you talked about bootstrapping. We've talked a little bit about equity and debt. Are there any other, like, I mean, are there really any other options of financing a company?
Yeah, I mean, there's I mean, like the owners, kind of putting in some money. There's the debt finance and equity financing. I think, I mean, if you think about a growth company, right, I like to say it sucks cash like a vacuum, right? Because it's growing, and you're going to need cash, and it might be all three. I'm not sure of the
Oh, that's
situation, but
true. Yeah.
even then, I mean, there could be some sort of, I don't know, grants or something that you can probably obtain depending on the business and industry that fit that kind of bucket to get some cash that might not be paid
Mhm.
back, which would be great. But um, those are some of the big areas.
Yeah.
Maybe there's like, but sometimes you might be established, to get some sort of like AR receivable, factoring there, or some sort of like advance, that they'll might take some of the AR, or if you're a point of sale system, they might just take a piece of all those transactions to make a payback. Higher interest rates though, but so there's some of those, but still it's kind of debt financing.
Yeah, I guess the other one that came to mind too was some sort of like a joint venture where the risk is
Oh
split
yeah.
between two different entities, and when we both put in sweat equity, but then you get leverage. You can grow and scale that way without necessarily giving up as much. Well, good stuff. I guess so. The other thing you just mentioned, like a factoring kind of situation. That makes me think, is all debt created equal, or what is a factor? Maybe not everyone knows what a factor is.
Yeah, I mean, when you say like all debt, is it created equal? Um, I wouldn't, not at all. Yeah, I think there's different types of like that debt. There's the structure, right? What kind of terms there are, and you have like the line of credit, from like a banking institution to have as a just in case or what if scenarios that come through. Asset-backed loans, if you're very big on inventory and assets. I've been at companies where we do have the ABLs there where you can borrow against the inventory. It's like usually 50% inventory, about 80% of your AR. And that can change, right? Or there's, even like convertible notes where it starts off as debt, and then the future that can convert into equity too. But, from a factoring standpoint, is they're borrowing, they're kind of assuming their AR, but this lender would pay back and give cash up front, and that AR is collected, they take their cut too. So there's different options and different types. So I wouldn't say that's all pretty much equal, but it's still debt.
Do you have any type that you feel like is, I mean, like, how do you know? Like, okay, like let me just say this a different way. Like I know that a lot of businesses use Stripe and PayPal to
Mhm.
collect their process payments, be it credit cards or PayPal payments or whatever it is, right? And or even ACH. And so Stripe and PayPal have insight into the volume and of transactions and the dollar value of each transaction, and so they can get comfortable with lending a certain amount of money to a business based on the history that the business has been using through that platform. And so then there's, I've seen businesses that leverage that because it's easy and it's quickly, it's quick. You go online, you click a few buttons, and boom, you got 100 grand in your bank account. But how do you know? Like you mentioned, like they take a tiny chunk of the cost or of the future receivables. Um, so the question is, so it's similar to factoring. It's not exactly the same, but it's similar. And I can say that it's, what's the word I'm looking for here? It's convenient in a bunch of
Mhm.
different ways, but I think it's hard for people to know how much is too much and how much it's going to hurt tomorrow, right? Because like you said, it's that tiny little bit, but is it tiny? What's
Yeah,
tiny?
like, and that's where I think, not, like you look at, let's say like an e-commerce business or some sort of point of sale, like a restaurant of some sort, where transactions that take place every day. and it might be like $50, $100 there. Like they're, collecting small chunks of that, but I wouldn't say it's less. In fact, it might be even more expensive in terms of their rates because they're advancing that cash, fast. Usually I've heard even sometimes it's like in a day, you can get, thousands of dollars pretty fast, but at the end of the day, it's probably more expensive than to go to like a bank to get a conventional loan as well. But it's easier to do this. It's very convenient.
Yeah.
And that's why I think it is a little bit more because you're paying for that.
Yeah, and I think there's like three sides to the convenient. One is it's easy to get because to make it easy. Two,
Yep.
it's the payback is based on the volume of the sales transactions that you actually have in the future. So there's actually you can be paid back faster or slower depending on how much you
Hmm.
actually run through the platform. And so that's also convenient for you. And but and they have leverage, right? Like they're like we're going to get your money because you're going to continue using our platform.
Yep.
Um, but the problem is that you're paying for that convenience, right? It's
Hmm.
not like if you're going to go down to the bank, they're going to ask you a bunch of questions and pull your credit and that one financials and tax returns and all this stuff because they're going to do a bunch of their own diligence to limit the risk. So since you have to put in more work and the payback terms are different, it can be more affordable though it takes more work. So
Yep.
I guess do you have any rules? Because the other piece is like that I look at with these Stripe and PayPal loans is like if you're if you have multiple ways to collect money, like some people send checks, some people send wires, some people pay by credit card, then factoring or using one of these short-term loans as a, a portion because it's only affecting a portion of the cash flow is significantly less risky if your only way of collecting money is through Stripe.
Yep.
So I
Very
guess in
true.
that sense, do you have any like rules of thumb or like ratios to try to think about or ways to monitor like how much is too much? Like if I'm doing 100 grand a month, should I borrow 10,000? Should I borrow 50,000? Like what's the rule of thumb there?
Well, yeah, and that's I think a wonderful question because I think when someone is starting out and they're like, we need cash, we need cash, and it's not so much of like the analysis behind it, and meaning like, if someone's willing to give you $100,000 or $1 million, like, hey, that's great, we could use that, but like is that even feasible? And what I mean by that is to really understand like what you need, right? And you might talk to some folks that have done that little bootstrap. The owners put in some money, now they're growing and say, okay, we have some sort of proof of concept and we'd like to raise money, whether that is a debt financing or some sort of equity. But it's like usually you go to that table saying, and the bank will ask you the same thing. Well, how much do you need? And show me like some numbers, some sort of runway, because they're lending it. That's not a grant. Like they want their money back, so they were trying to ensure that. So, but a lot of times they will look at some ratios to look at debt to like their EBITDA. There's a debt service coverage ratio that really understands if you take on debt in the payback, like how much like can your business be sustainable by paying that back? And a lot of those ratios are tested, part of their loan covenants and the banks or some sort of institution, if it's debt, they'll test those. Either it's usually it's done quarterly, and then yearly too, just to make sure that you're not tripping up any covenants that will require them to kind of take some action, which I don't know what's in the language of some sort there, um, but it's usually monitored and tested. So as the person received the money, not the lender, you kind of have your homework. It's part of the loan requirement is to maintain those certain ratios. But understanding cash, right? Understanding what is the business operating cash flow. I think some businesses could be a little different in terms of their operating, but just understanding like how much that business is making, how much can you pay back as part of like your cash flow can help determine that too from a debt perspective.
Yeah, and actually that makes me just kind of not to beat up Stripe too much, but it makes me think back to that example of how easy to make it is to get those loans. They don't ask lots of times for a full financial analysis to
Hmm.
understand what your debt coverage service coverage ratio is. They just say, well, you know, they know how much volume they do, and so you've been doing historically, so they just calculate based on that versus saying, well, we don't know what other issues they might have, and so that's not our problem. So
Yep.
so in some sense that is also a red flag, if you will, if they don't ask for all of the other things to understand what the full risk and the full profile and the full financial situation of the company is.
What I think
Well, cool.
helps too, like even traditional banking too, but it's the personal guarantee too. I mean, you're going to be required to sign something there personally that for some reason the business fails, they're going to come after you personally to get their money back as well. It's part of that process.
Yes. That's for sure.
Yeah,
They will
I'm not a
spend
fan of
lots of
that.
money and time trying to get their money back.
Hmm.
Um, so I guess the other thing is, all right, so let's just say someone has a company's feeling the squeeze, they feel like they might have borrowed too much, they're having trouble meeting their obligations. Now what? Is it better to take immediate action or just try to ride out the storm? You know, what's the usual? How do you think about that scenario?
Yeah, like and that is common, and from experience, even talking to a lot and knowing a lot of bankers, it's just being upfront earlier the better, right? Because even if there's no storm happening right now, but just having good communication with the lender, whoever that may be, just saying that there might be some cyclicality in the business or times might be a little crunch, they're usually willing to work with you. And I don't know if that means refinancing or maybe there's another loan you can probably negotiate with another lender that, at a better rate of some sort. But then also it's, depending on how much, I mean, maybe there's an operating, there's too much spend going on that maybe there's some operating expenses that you can cut to be able to free up cash to pay that back. But for me, it's really just being upfront as soon as, and there might not be a problem, but even having that communication builds trust and that, they're willing to work with people.
Yeah, that makes sense. Because I feel like there's lots of people who they get into a situation where they're kind of running a little negative. They borrow some money, and then that runs out. They want to borrow some more, and I think there's a two parts to it. One is like, okay, is this a short term problem or is this a fundamental problem, right? Are
Hmm.
we saying, do we get a big deal? We have to buy a bunch of, you know, do a bunch of work or get finance the purchase of a bunch of things to close the deal or to finish the deal before we get paid, or is it just we're spending more than we each have a burn rate. We're just spending
Yep.
through, and that's just what we have to do. Or are we spending through? And we're just wasting a bunch of money, right?
Yep.
So,
Exactly.
like I had one guy who was really interesting. She was making about 100, she was taking home about $150,000 a year. And I'm like, okay, well that's all right. You're not Bill Gates or whatever it is, but you're definitely doing okay. She's like, well, but the business is. I think my business is failing. That I need to make more money. And I'm like, well, what's the issue here? Is the issue, do we have a spending problem? Do we have a debt problem? What is the real issue? And after kind of pulling back a few layers and talking about it, it's like, okay, you're spending 20 grand a month. Of course you do. Of course you're not making it at the end of the month because you're only bringing home like 14,000, right? So
Hmm.
or 12 or 13,000, right? So then it's like, okay, you're gonna have to, like, by analyzing and paying attention, you can figure out, okay, are we which type of problem we had.
Yep.
So, well, good stuff. I guess let's see here.
But even in that situation, if I could just add, like,
Yeah.
not sure of the situation, but it does, I think, might need some sort of look under the hood of, why, right? Are they overspending? And this person, it says making 150. I don't know if that means that's revenue or that's their take home pay, like I'll look at cash and just start diving into, just to see where that root cause is. And it might not be like a revenue issue. Maybe it's a spend problem, I'm not sure yet, but it just when you start having those thoughts in the head, it definitely works. Or there's definitely a need to start looking under the hood here of just figuring out why.
Mhm. And I guess the other thing is, I guess the other thing is like emergency mode. Like, okay, well,
Hmm.
now you gotta can't pay the vendors, can't pay employees, stop paying the rent. So it's giving, like, that's like what you want to avoid at all costs. Um, and I guess to avoid that, what would you recommend?
Yeah, I mean, I think there's a couple. It is such a valid question and point too, but I mean, for one, it's just, I like the cash flow forecast, right? Number one is just understanding the inflows and outflows of cash, right? 13-week cash flow is kind of that normal, rolling cash flow, but also from a forecast perspective too, and you can tie them together, but outside of just actual cash going in and out, but what is that revenue, forecast, kind of taking place, the next, 13 weeks as well. And then even just having some sort of like, call it contingency plan. If what if this happens? It might not be happening right now, but let's just say it does, or it starts to get in there. Like you kind of are, no one say prepared, but you're like you're ready to take, that next step into some sort of contingency plan. And even if like you don't, I always tell like even newer stage businesses, whether they're early or not, but having some sort of credit facility, some sort of line of credit, even if you don't need that, one, it's a lot easier to obtain that money now when you don't need it, but two, it's there in case there are those, cash strap and those short-term cash needs that you could tap into it. So in this case, you might not need it, but it's there as a cushion for those unforeseen events that might take place. And that all comes down to that contingency plan of just like of these what if scenarios. And that should be part, whether you're small or big, is just, forecasting, and what if scenarios are helpful and to help maintain these unforeseen events.
Yeah, and for sure, keeping a healthy cushion, cash cushion.
Hmm.
Um, we there's I guess there's two things that we like to talk when I talk into business owners to think through. One is keeping an eye on the current ratio. Just okay, what are our current assets? Cash, receivables, inventory versus our current liabilities. Always want to be um, above 2 to 1. Ideally, 3 to 1 is even better. But then, I guess that there's a tangent there on that on the current ratio as well. And then also another way to look at it is just burn, right? So it's like, okay, like let's just say you're spending $10,000 a month. How much cash do you want to have? Having a couple months cash, a couple months of spend in the bank, well, it gives you security in the sense of like, okay, well, if there's a huge hiccup in receivables for whatever reason, be it permanent or temporary, your fault or not your fault, that you can continue to meet your obligations and, the wheels don't come off, immediately, right? So there's those two rules of thumb, a couple months of spend in the bank and on the current ratio. So another
And
question,
just
go for
like,
it,
can I just add to that? It brought back a memory that even just during COVID, regardless of, debt, financing, but just in terms of like emergency, funds as well as contingency planning. But even I remember specifically, it was right before COVID was kind of being, announced that this was like a pandemic here in the States, but also globally. But, sitting down and part of a CFO group, and we were sitting down with other CFOs, and there's probably about 15 of us, and the conversations were kind of interesting because, a lot of these folks were talking to their CEOs and their board of, listen, if revenue stops because of this pandemic, like what is our, like how long can we last? And these are questions that no one thought that they would ever have to ask, but it kind of kicked in the gear of these contingency plannings and these what if
Ahead.
scenarios of there may not be a global pandemic again, there might be, but it's also like, hey, if something like that happens, what are we doing? And it kind of builds people's now reserves and all these planning. So it's I think it's very critical that it's one of those like you have it there, but you hope you never have to touch it and use it.
So the other thing I was gonna another nuance I was going to bring up is there's some people who are very debt adverse, and I have like we have some clients who are in the service industry who don't necessarily need to uh, purchase a lot of fixed assets, so they don't need to take on a lot of debt, and they might have a current ratio of like 8 to 1 or something like that, where they have a bunch of cash and receivables, but don't have a lot of current liabilities. And then you say, okay, well, is that being too conservative? Are they being inefficient financially? Could they be more um, could they be more profitable by being slightly leveraged? By being like essentially if you're 8 or 9 to 1, you're having the leverage, right? Like you're having the
Yep.
liabilities. So I guess that's another question is like, is it smart, if you will, to leverage the company if there is no immediate need necessarily to borrow money.
Yeah, I mean, I get that. I've met some people who are like that too, but I think when used, I guess, I don't say properly, but when you use it in a way that you're not taking on too much or you can't, pay it back, I think there's benefits to that, not only to provide cash into the business, but um, like for instance, the interest on it is tax deductible, right? Dividends are not, so there's some of the key pieces of, debt financing compared to, equity. But, at the most part, I mean, it's like sometimes you might have a credit rating, and just like a person, looking at companies' credit rating, if you build a credit, then more people will lend to you or express and take advantage of the terms that get pushed out too. Um, so I think even if someone that is very risk averse and taking on debt, I mean, you could start small and just take out a small and just try to get comfortable with it. And again, if you don't need that cash, if it's more of, being able to, kind of fund the business without it. But to me, I think it can increase the profitability.
Excellent. And I guess that's the name of the game here, right?
Exactly. These are
To make it
for-profit businesses.
exactly. Well, this also makes me think of the whole thing of like, you can't make an omelet without breaking eggs, right? You got to spend money to make money. So sometimes you're taking on debt or taking on equity is really the only option, and it is the best option in order to make things happen. So, wrapping things up here, I think there's a couple good takeaways. Cash flow forecasting, and keeping a cushion and keep an eye on those ratios, be it the debt service ratio or the current ratio, are excellent ones to keep tabs on, just to make sure you're not getting in over your head and getting ahead of your skis. Anything to add there?
No, those are some of the key points that I would kind of reiterate too, is just, looking at the cash flow forecasting, understanding, the needs of that business, how much you need. Cash, I think it becomes dangerous when, cash flow is not either managed or unpredictable, or you can't meet some of those debt covenants, and trying to determine that beforehand can help save a lot of time, money, and stress.
Excellent. Well, thanks again for joining us today, and we will be back again next week with more good stuff. Take care.
Thank you guys. Thanks.